Thank you for your time today, Dumebi. And let's first start with that, the primary market auction there was seen from the T-bill side, and how today's auction compares with the previous ones that we've had.
Good afternoon, Kenneth. Thanks for having me. So the NTB auction today, we only have about 47 billion being offered compared to 120 billion that offered in the last auction. The last auction stop rates were retained at the 91-day, 182-day, but increased on 365-day bill from 5.5 to 6.5. So we do not expect the reaction we got from the last auction to be compared to the one we're going to get in the auction. Reason being, we have a small amount being offered, about 60% of the former amount being offered, about just only for 7 billion being offered. So we do not really expect the result from the action to really affect the market. However, we foresee a maintenance in rate or a hinge up slightly in the long end to probably 7% from 6.5%. But apart from that, we do not really expect the activities at that auction to really move the market as it was from the previous auction.
All right, we're looking at the debt management and debt strategy so far, looking at what we saw play out with the recent figure they put out, the 2.9 trillion naira as at December, being owing right now. How do you think this is going to make the impact things, how things are going to play out going forward?
Sorry, could you come again? I didn't get you, please.
Yes, I want to get your take on the new debt figures that we're seeing, that 2.9 trillion naira from the DMO as announced yesterday. But looking at how that debt is, I'd like you to just speak on the wider implications of this debt in the Nigerian capital markets.
So basically, the DMO has made it clear that they would want to borrow more irrespective of the cost of debt servicing, but they want to be smart about it, knowing fully well what we experienced in 2020, how serious that we are ravaged by the negative effect of the pandemic, and why we need to stimulate the economy, most especially the real sector, from the effects of the pandemic. So they made it clear to more or less to plan to borrow more to more or less stimulate the economy. We still have a 2.3 trillion stimulus package, which is about 4% of our GDP, to be pushed out into the economy, and we also plan on helping us get our full economic recovery. If you know, recently this week, the economic indicators came out. We had an unemployment rate at 3.3%. We had inflation at 17.3%, which clearly shows a positive limit sloping Phillips curve in economics, which is very bad for an economy to have short indicators. So the ideology of the focus is how can we get ourselves back to, 2019 levels, or even better. How do you push the economy better? And one of the ways to do is to spend. You will have to spend or more or less invest into the real sector. And one of the ways the government plans to do that is to borrow more. So we might see higher increase in our debts, but however, it's all poised towards getting the economy to a stable and sustainable level.
All right, it was a good one. You mentioned all that flurry of data that came into the market, inflation, unemployment, like you rightly mentioned. But looking at the MPC next week, though, what options do you think is there for the monetary authorities?
Well, it's like I earlier said, they are very trying times right now with an unemployment figure at 3.3%. Research say and unemployment that is more than 5% is worrisome. So imagine us being at 3.3%. On our inflation figures, we're at a 33-month high, a 17th month consecutive increase to 17.3 from 16.47 and from also the 50.75. Like I earlier mentioned, in economics, where we are right now is a positive limit slope Phillips curve, which is a clear sign of issues that are around the economy. So it's quite worrisome. So for the monetary policy rate, I can comfortably say that they have exhausted whatever they can do, because the inflation isn't a money supply. It's a demand push and cost push. Reason being increase in the cost of imported goods. We see where dollar is right now. We've seen the partial depreciation in the ionic window. We are seeing highs of 412. The parallel markets are 475. So it's a cost push inflation we're seeing, and also a demand push inflation. It's not a money supply. So at this point right now, we need a synergy or a handshake between the fiscal policy and the monetary policy poised towards economic growth, economic sustainability, to try and curb up this problem. So I foresee a maintenance in rates by the the MPC, by the central bank during the MPC meeting next week. An increase might further make it a harsh environment to lend. If you increase your MPR from what we have at 11.5, it might make it more worrisome to lend to the real sector and more difficult. And a reduction further causes a higher negative rate of return. So a maintenance is key, and some other means, like I earlier said, a handshake or a synergy or a more formidable policy should come out poised towards economic growth. The MPR and CBN have done a tremendous job trying to maintain price stability, but right now it's more worrisome, and we need more than just the monetary policy. We need a strong handshake and synergy between the fiscal policy and the monetary policy, poised towards economic development, sustainability, and growth.